traders. Today I wanted to talk to you about options. This is, a video kind of a continuation of the series of trading, and where we're breaking down, stocks, options, and futures, the good, the bad, the ugly, so to speak. So I wrote down some notes here on options. Some of the good points of trading options is there's less capital required to trade. You go out here to buy say a $50 stock, and you want to buy 100 shares, that's $5,000. But you can trade options on the same stock for, a lot less, $100 to $150, maybe even $200. It all depends on what type of option strategy you're implying. And, sometimes you can trade it for less than $100. And we'll have to talk more about that in a video coming up in the future about option strategies. But there's a lot less capital required to trade options. Options offer you more leverage. Again, going back to buying the stock, if you buy 100 shares of stock and put up $5,000, well, you're controlling 100 shares of stock. So as the stock moves up or down by $1, you either gain or lose 100. With the options, you can control the same amount of shares, 100 shares, for a lot less money. So it gives you more leverage on your money, an opportunity to make more money with less money involved. Options also allow you to limit your risk. For example, there are strategies where you buy an option, and let's say you pay 75 cents for the option, which is $75. They're trade in increments of 100. So you buy and pay $75. Well, that $50 stock again could go to zero, go bankrupt, go out of business overnight, and your max loss would be $75. Where if you bought the 100 shares, and paid $5,000, and they were to go to bankruptcy, you would lose all $5,000. I put down a defined risk trade, just kind of talk somewhat about that. A defined risk trade means, again, if you buy an option and paid 75 cents for it, or $75, that's the most you can lose, regardless of the price. That $50 stock went to 100, or the price at $50 stock went to zero. When you buy an option, it's a defined risk trade. The most you can lose is your initial capital outlay. Okay, I also put good for time decay. Options are priced, they're a contract that you either buy or sell. They have a definitive time on them. You can buy an option that, or sell an option that expires on the same day that you buy it or sell it. Or you can go out, way in the future, over a year in the future. But they all have a definitive time set when you buy that, and you know what it is by what option you choose. Unlike a stock you could buy today and hold for your entire life, and will it down to your children, your grandchildren, whatever. But options are all time-based. You're going out 30 days and 45 days is very common options to trade. A lot of people trade those. So they have time decay. Options price is made up of how close it is to the price of the current stock and a time factor valued into that. And we'll talk about in the video of what types of trades for options, but we'll talk about how to take advantage of time decay. Options also offer you the opportunity to repair a bad trade. And we'll say in a stock, you buy 100 shares of stock, and it goes down $5 a share. Well, there are ways to use options to recover that. You could sell call options against the stock you have and collect some premium, which would reduce your cost. But with the options, you can repair bad trades by doing many things. If you started out by selling a put below the stock price and the price goes down, you can then turn around and sell a call above it. And again, this is going to get really kind of deep and it's not for this video, but this video is just to let you know that you can repair a bad trade. Okay, now some of the bad things about options is, I've got time decay down here as well. Well, if you buy an option to start with, time decay works against you. If you sell an option, time decay works for you. So it all depends on your opening trade. You can get assigned to stock. If you sell a call option or sell a put option, you can get the shares assigned to you. And we'll have to talk more about that again in a future video, but you could start it out as an option trade and wind up owning stock. There are ways to, I'll say, somewhat defend against that. Most of the time this happens is when a option on the day that the option expires or the day after it expires, if you're holding options that are in the money, that's usually when you're going to wind up getting assigned to stock. So if you trade your options, close your position out, or roll them farther out in time, with a week or two to go, very rarely are you going to get assigned to stock. There's no pre or post market trading in options. Options trade when the market's open from 9:30 a.m. Eastern time to 4 o'clock. And I believe the SPY and trades for like 15 minutes after, but there's no, getting up at 4 o'clock in the morning when you can trade stocks in pre-market. You cannot do that with options. Spread trades can have limited gains. If you place a spread trade in an option, it can have both limited gains and limited losses. But, if you were to buy that $50 stock and that thing were to go to 100, you'd say, oh, man, I made $5,000. But if you'd had a spread trade on it, your profits are limited by the width of your spread. And again, we'll talk more about that as we do another video where we talk about types of option trades and the risks involved in it. Well, I hope this it's kind of a short video here and kind of just hit the high spots. It's not a real in-depth video of options, but hopefully you have learned something from it. So good luck to you out there.